So greetings, welcome everybody. Good morning, good afternoon, good evening to all participants of this IAA SIF joint webinar. My name is Gabor Hanak and I am the chair of the IAA's Climate Risk Task Force. So the main topic of the webinar will be to present some of the major ideas or messages in the paper recently published by the IAA with the title Application of Climate-Related Risk Scenarios to Asset Portfolios. So the short name will be asset paper throughout this webinar. So I will refer to it as asset paper. The agenda for the day and this webinar will run for about 90 minutes. We will hear two presentations, one from two of the authors of the paper, André Choquet, who is the lead author of this paper, and Elaine Tai, who is one of the authors of this asset paper. And they will present on the some of the main messages and ideas of the asset paper. And there will be another presentation from Willem Harding of the Sustainable Insurance Forum, and he will be talking about what the SIF and its members are doing and how they are supporting the IAIS, so the International Association of Insurance Supervisors, on scenario analysis and how that work is related to actual contributions. And then the last part of the webinar will be a session of Q&A, so questions and answers. We'll see how much time will remain depending on the time remaining and the number of questions. This may be an oral exercise, so you may ask questions orally, or you can ask questions or make contributions throughout the webinar using the Q&A feature of Zoom. You will see the Q&A sign on the bottom of your screen, and if you click on Q&A, you can ask questions. So I will monitor the questions and answers as well as the chat function also available. But I encourage you to use the Q&A feature if you want to ask questions or make contributions. And depending, as I said, the time and the number of questions asked, in the meantime, we'll have a Q&A session of more interactive oral contributions or just referring to the questions asked before. Now, all participants or all attendees of the webinar will be muted, and perhaps toward the end, when we have an oral session of Q&A, they will be unmuted. If that is the case, then please raise your hand. You will see the raise hand feature at the bottom of your screen. And then if you raise your hand, I will recognize you in turn. The webinar will be recorded. If you disagree with a potential recording of your message or your face, then you will not share that, or you can quit. The slides shows, the two slideshows that will be presented will be available together with the recording of the webinar after the webinar in reasonable time. So as an introduction to the paper, I got to say that the IAA decided 2 years ago to set activities on climate-related risks as a strategic initiative of the IAA, approved a broad work plan and created the Climate Risk Task Force. That was in 2020. Since then, 4 IAA papers have been published and 4 others are in the pipeline. And this asset paper is the 4th in the series. At the same time, or in the meantime, we joined forces with the IPCC Working Group 1 and produced another paper, which is called shortly Summary for Actuaries. And that paper was also recently released by the IAA. And about 2 weeks ago, there was another webinar on that paper. In line with the IAA vision and missions, we want to contribute. We, as the representative of the global actuarial profession, we want to contribute to the global discussions on climate-related issues with an actuarial insight and clearly show how actuaries can handle complex issues and how we can add value. We also want to inform all interested actuaries around the globe about the efforts made by our task force and its drafting teams, and how those efforts can be viewed and built on from an actuarial perspective. All authors of the asset papers and the members of the task force are excited about the impact this publication will make. So far, I've been hearing very positive feedback. For example, in my own work network, I sent the paper, and there seems to be a huge interest within my network around this issue and the paper itself. Now, I would like to give credit to Micheline Dion, who was the former chair of the Climate Risk Task Force of the IAA until she was elected as president-elect of the IAA. And so I was appointed as the new chair from January 1, 2022. The asset paper, the development of the asset paper started under her leadership. So thank you, Micheline, for your hard work on starting this paper. Now, let's give the floor soon to the presenters, our presenters. So first, André Choquet will start the presentation of the ideas of on the paper. André was the lead author of this asset paper. He is a fellow of the Canadian Institute of Actuaries and the Society of Actuaries, a chartered investment manager and a responsible investment specialist who partners with institutional asset owners to review, adopt, and implement investment strategies that integrate climate-related risks and ESG factors, and to provide strategic advice on their journey to net zero. André is also the chair of the Climate Change and Sustainability Committee of the Canadian Institute of Actuaries. He will co-present with Elaine Tai, an author of the asset paper. Elaine is currently a credit analyst at S&P Global Ratings based in Singapore. She is responsible for credit surveillance of insurance companies in the Southeast Asia region. Before joining S&P Global Ratings in 2021, Elaine spent close to 8 years as risk manager for various insurance companies. Elaine has a keen interest in sustainability and works closely with the Singapore Actuarial Society on developing sustainable initiatives. Elaine is a fellow of the Institute and Faculty of Actuaries, a certified financial risk manager, and holds a chartered financial analyst designation. She is a member of the IAA's Climate Risk Task Force. So, André, the floor is yours, and Elaine, please start your presentation.
Thank you very much, Gabor, and good afternoon, good morning, and good evening, everybody. It's a pleasure for me to be here. I just want to give kudos and thank you to my co-writers for this research report. So Ludina Erasmus from the Netherlands, Dale Hall from the US, Paul Mains from the UK, and Eileen here today from Singapore. And also the wonderful people at the IAA, Micheline that Gabor mentioned, Nancy Kelly and Emily Seneveretti as well. So, and finally, all of those who contributed through your reviews and comments. This was really appreciated and made a much better report. So I'd like to start with a brief review of climate science. I think it's really important to stress some important issues. And of course, climate science is not climate guarantee. in the sense that the science evolves. There's more information that's known all the time. I refer to you to the report that Gabor mentioned between the IPCC and the IAA that was issued last month. But still, there's a couple of key, I would say, key performance indicators related to climate change that are really important to keep in mind as we journey on. So greenhouse gas emissions, basically we issue about 51 billion tons of greenhouse gas emissions annually. And the goal is to reduce that to zero. There's no ifs and buts about it. That's really the goal for everybody on this planet. Carbon concentration, think about that as the debt that's accumulated over the years. 412 parts per million doesn't mean much maybe to most people, but let's say that if it reaches 450 parts per million, we're in trouble. So, and trouble means that temperature will continue to increase. We're on a 1 degree level relative to the start of industrialization, and we're on a 3 degree trajectory based on the current, let's say, goals or pledges, and we need to keep well below 2 degrees Celsius and ideally 1.5 degrees. So you've seen those numbers before. The nationally determined contributions, these are, this is the heart of the Paris Agreement. These are the achievements and the long-term goals by countries that have signed up to Paris Agreement to reduce their national emissions and adapt to the impacts of climate change. So these are key in the next meetings of COP. Greenhouse gas effect, in a few words, well, basically it's a process that occurs when energy from the sun goes through the Earth's atmosphere and warms the Earth's surface. But the atmosphere and the greenhouse gases in it prevent the heat from the Earth to return to space, resulting in a gradual warming of the planet. And if we want to avoid disasters like a global COVID crisis every 10 years, we need to gradually reduce our greenhouse gas emissions, and it's a mission for the whole planet, of course, not just a few countries. This type of graph, when you look at the climate science, you see a lot of those I call it exponential graph, in the sense that, you know, you see for thousands of years, things being stable on the left-hand side, and then suddenly in the last little bits on the right-hand side, you see this trajectory on an exponential basis. In this case, this is the atmospheric concentration of CO2, but you know, you can see the same type of effect on global population or other metrics. So those who are skeptic about climate change, I think, need to review a lot of these exponential graphs. We think that reducing greenhouse gas emissions is all about getting your Tesla and your electric vehicles in your garage, but there's a lot that's going on in the emissions of greenhouse gases. And actually a big contributor is the making of things, the manufacturing of cement and plastic, which contributes about 31% of the 51 billion tons of gases. And by the way, a good book, easy to read and very interesting to get your senses around what needs to be done, is the Bill Gates book, How to Avoid a Climate Disaster. This graph is taken from that book, and he explains in plain language the technologies we have and the technologies we need to get in kind of like, he talks like an engineer in a way. So it's very interesting to understand what needs to be done. So enough about the climate science. Let's get into the heart of the paper. Why did we write this paper? Some people are wondering, what do actuaries have to do with assets? Well, the assessment of assets is an integral part of our work. Climate-related risk basically may affect the likelihood and the timing of expected future cash flows. And most will agree here that climate-related risk will impact both assets and liabilities of the financial institutions, the pension plans that we are advising to, or that we are employees of. Although a lot of actuaries may not be involved in security analysis or portfolio management, they are often the ones certifying the long-term viability of pension plans or insurance companies, which depend on the performance of their assets. So therefore, actuaries have an interest in leading or participating in climate risk assessments, scenario analysis, stress testing, to quantify the impact of climate-related risks on asset portfolio. And there's also the issue of stranded assets that all asset owners keep an eye on. If currently some companies in the oil sector, for example, the values of those companies are based on oil reserve, such value will gradually or suddenly decline because a big chunk of the oil reserves globally will need to remain underground if we want to reach the 1.5 2 degrees Celsius goal. Although to give credit to some oil companies, they are diversifying into renewable energy research and development. And also another factor that we have to keep in mind as actuaries is that a lot of our pension fund fiduciaries, insurers, and other financial institutions have a legal or business or even moral duty to take climate-related risk into account in the management of their companies and their assets. And we are strategic partners to those fiduciaries. And finally, on the liability side, the discount rate used by actuaries to discount long-term obligation is based on the expected long-term return on assets, which in turn are affected by various climate scenario patterns. This is just a review of all the risks, what we call climate-related risk, and I refer you to paper number 1 to get more details. But basically, we have the physical risks, so changes in weather patterns that increase the financial impact on physical risks, and especially affecting general insurers. And we have on the other side the transition risks, which are which relate to the transition to a low carbon economy. And here we have the interplay between policy, technology, and market or consumer preferences. And that interplay, I'll come back to it later on. It's not linear. It can be orderly, but it can be disorderly or even delayed. So that will lead us in different trajectories into the future. And of course, legal and reputational risks, which take more and more precedence going forward. There are a couple of, the paper speaks about 3 global NGOs actually should familiarize themselves with a lot. Well, the first one, we know a little bit more, the IPCC, thanks to the paper from last month. That's the Intergovernmental Panel on Climate Change, the UN agency, which is really the most credible NGO on climate science at the moment. Greenhouse gas emissions and carbon concentrations have a direct linear relationship with global warming, as can be seen on this graph from the IPCC AR6 report from work group number 1, which was issued last August. There are 2 more reports that were issued later on, work group number 2 and number 3 that we'll talk about later. But even the current pledges by signatories of the Paris Agreement still lead us to a trajectory above 2 degrees. So that's why there's a very urgency on getting these national determination agreements to be somewhat more standardized around the planet and more strengthened. No probabilities, as you can see. I know actuaries are used to assign probabilities to possible futures, but there's no probabilities assigned to these because they really depend on the actions we take today and tomorrow. That will determine which scenario we'll end up with. So you should familiarize yourselves with the studies of the IPCC. These pathways, they form the basis for climate scenario analysis. Another agency is the International Energy Agency. which was created in 1974 to help coordinate a collective response to major disruptions in the supply of oil. The IEA has evolved and expanded significantly since its foundation, and now it is taking an all fuels, all technology approach. It recommends policies that enhance the reliability, affordability, and sustainability of energy. So it examines the full spectrum issues, including renewables, oil, gas, and coal supply and demand, energy efficiency. So they are experts in our energy needs of the future, which are crucial, of course, for our economies. It issued a report in 2021 on the roadmap to net zero, which is a worth read. It includes, as a summary at the end, pretty much electrifying end-use applications, decarbonizing power sector, puts a lot of emphasis on carbon capture and storage, which, true, the technology is not necessarily there yet, but it will be part of the net zero goals into the future, and removing CO2 in the atmosphere as well. And finally, another agency we talk about in the report is the NGFS. So that's the Network for Greening the Financial System scenario. A lot of the banks and insurance companies are using actually those studies from the NGFS. In 2021, it published new global scenarios. So it's focused more on the economic impact of climate change. So the economic impact on GDP growth and inflation, which the IPCC doesn't necessarily get into. So this graph, for example, shows the impact of various future scenarios on greenhouse gas emissions. The gray represents the impact on GDP of transition risk, while the green represents the impact of physical risks. So the three bars on the left show the, over here, those three bars show the NGFS net zero 2050 scenario, which is the most optimistic scenario, with GDP impacts limited to below 3% relative to the baseline, and mainly resulting from physical risk already locked in by historical emissions and a 1.5 degree warmer temperature. And then we go into further on delayed transition, meaning that we don't do much for a long time and then suddenly there's panic and we need to decarbonize. So the GDP impact is 5% below baseline by 2050 in this case. And then if we don't do anything, of course, there's not a lot of transition risk impact on the right-hand side, but then the physical risk steps in later on in 2050, 2100, and then there's a major impact on GDP growth after that. Of course, the global aggregation of GDP masks some differences in impact at a country level. For example, in Canada, where I come from, we would have much more transition risk impact under a net zero 2050 scenario because of our reliance on fossil fuel energy for a major part of our economy. But while Europe would have much higher physical risk impact from flooding and wildfires under a hothouse scenario. In our paper, we talk about, we talk about bottom-up analysis versus top-down analysis. So in essence, bottom-up is analyzing securities in a portfolio and how they might be impacted by various climate pathways. And a good report I would recommend is the final report on the Bank of Canada Office of the Superintendent of Financial Institutions Climate Scenario Analysis pilot that came out after this report was pretty much finished. It came out in January 2022. The link is written at the bottom. But basically, it gave the bank a better understanding of the potential impact of transition risk on the Canadian financial sector, using 6 major players as participants as well. The methods used to assess climate risk at the individual security level are still developing based on our research, and practice may vary from geography to geography. Portfolio managers who use a discounted cash flow model to value securities, for example, may stress test their portfolio against future carbon pricing policies. I remind you, in terms of carbon pricing, the metrics of choice are the Scope 1, Scope 2, and Scope 3 metrics. Scope 1 are the emissions that a company are emitted. Sorry, the emissions that a company emit from their own controlled resources. Scope 2 are indirect emissions from the generation of purchased energy from a utility provider. So whether that utility, for example, electricity coming from coal or from hydro resources, will have a different impact on Scope 2. And Scope 3 are basically consequence of the activities of the company, but occur from sources not owned or controlled by the company. For example, extraction and production of purchased material, or transportation of purchased fuels, and use of sold and of products and services. So Scope 1 and Scope 2 are typically easier to get in terms of data than Scope 3. But there's an attempt at various regulators, securities regulators in Canada and the US, for example, to force companies to release data on all scopes, further to TCFD recommendations. And portfolio managers like to follow trends in their portfolio data, not necessarily point in time. It's difficult to compare from one company to the next carbon data. So they prefer following the trends, and even engage in some cases with companies to entice them to lower their emissions. These are a few international setting standard agency that you should be aware of. Of course, there's the famous TCFD, which basically was established by the International Financial Stability Board in response to concern about the impact of climate change on financial institutions. And although the TCFD recommendations are not legislation as such, they are being adopted as part of legislation requiring financial sector organizations to make climate disclosures in countries like UK, and proposals are being developed in Brazil, in the European Union, Hong Kong, Japan, New Zealand, Singapore, and the United States. And it's really the TCFD recommendations that have led to the acceptance of climate scenario analysis as a valuable tool in assessing climate impacts, a tool that actuaries can definitely either lead or participate in. The ISSB is a fairly new organization, 2021, COP26. It already issued 2 exposure drafts in March 2022. One deals with general requirements for disclosure of sustainability-related financial information, and the other one deals with climate-related disclosures. So this organization will have a lot of weight going forward. And the EU Sustainable Finance Disclosure Regulation introduced various disclosure-related requirements for financial market participants. It aims to provide more transparency and sustainability within the financial markets. And finally, the Partnership for Carbon Accounting Financials is setting methodologies for calculating of emissions from loans and investment made by banks and other financial institutions. When we look at top-down analysis now, another example I want to point to you is the IFOA, the Institute and Faculty of Actuaries or Tech Finance Scenario Analysis for Pension Schemes that was produced in 2020. Very good analysis, research on the use of climate scenario analysis from a top-down perspective. As I mentioned before, there is an interplay between government policies, new technologies, how they are funded by the private and public sector, and the market responses to both new technologies and to downgrading old fossil fuel related technologies. So all these are moving hopefully in tandem towards net zero, but it may not be the case. That's why a lot of climate scenario analysis consider typically 4 scenarios, like a baseline, a Paris Agreement, orderly Paris Agreement, disorderly, and some net zero 2050 scenarios, and look at the impact on financial institutions along the lines of those 4 scenarios. GDP, as we talked before with the NGFS organization, is a recognized metrics for growth, but there are shortcomings with that metric relating to sustainability and climate change. After all, when you think about it, it's the society's fixation on GDP growth that led us to the problems we have today. GDP may be increasing while air quality decreases due to the very industrial activity needed for GDP growth. So that's why there's more acceptance now about looking at broad welfare metrics and increasingly emerging popularity. Societal health measures such as education, women's rights, and the quality of the air and water are becoming more important as well in our measurements of sustainability in the future. Price of carbon emission is close to $10 per ton of carbon dioxide equivalent globally in 2020, but there are wide variation in jurisdiction influenced by policies. So, for example, we're looking at $100 in the EU emission trading system. So to be consistent with the goal of remaining within the carbon budget and limiting the rise in temperature, it needs to increase probably to around $40 to $50 to $80 per ton of CO2 emissions. So that's why a lot of companies are doing their own internal, even carbon, impact, even though they're not obligated by regulations to adopt a certain carbon pricing scheme, because they know it's coming at one point. As we mentioned before, actuaries need to model the impact of climate on both assets and liability in a consistent fashion, and the paper talks about that. Talks about briefly also about open source tools. These are basically being developed to enable investors to analyze the climate performance of portfolios and companies. So it's that type of open source tool actually that led us to innovate and to produce vaccines for COVID. So the same approach is being used as well on climate, collaborating between companies and sharing data in order to arrive at a solution, because it is a common problem at the end of the day. And you have more and more data providers that can be used to provide information on carbon footprints, companies' preparedness for future carbon pricing, physical risk, and exposure to fossil fuels and stranded assets, and portfolio alignment with net zero by 2050. I'm going to finish my part with just a brief table summarizing some of the advantages and disadvantages of the bottom-up and top-down approach. And really, I don't think it's an either-or necessarily situation here. I mean, I think as actuaries, you need to consider the purpose, just like any study. You need to consider the purpose and the goals of your clients when it comes to a climate-related risk assessment. And ideally, if resources are allowed, using both approaches in the study would provide a more complete picture. That's what the Bank of Canada and OSFI study did by using both approaches as well. But basically, on the bottom-up approach, the main advantage, you can reflect characteristics of the securities analyzed. But the disadvantage is that it's difficult to aggregate risk at the portfolio level, since data is not always comparable between companies and geographies. Regarding top-down, main advantage, it's easier to ensure that assumptions are consistent with one another, especially if you consider the impact of climate risk on both assets and liabilities. But the disadvantage is that sometimes you have offsetting positive and negative impacts that may not be apparent in your analysis. For example, the occurrence of a devastating natural disaster may depress economic growth, while the rebuilding efforts and upgrading infrastructure to be more climate resilient could potentially drive economic growth. So the nuances may not be apparent when modeling the impact on GDP using a top-down approach. So I'm going to stop here and pass it on to Eileen, who will discuss various considerations on different asset classes. Eileen?
Thanks, Andre. Hi, everyone. I'm Eileen from Singapore. In the next 20 minutes, I will share with you some of the general impacts of the climate-related risk on asset classes and our observations of what some of the industry players are doing. And all these observations are made in our personal capacity. In general, equity investments have the potential to be impacted by both climate-related opportunities and risk. Whereas given that bondholders don't enjoy similar capital appreciation as equity holders, bonds are generally more susceptible to downside climate-related risk. In particular, long-term bonds are even more susceptible to climate-related risk than short-term bonds, given that the effects of climate change tend to be more pronounced over the long term. Generally, physical risk scenario could affect the value of government bonds in countries which are highly vulnerable to physical risk and less financially resilient, especially in developing markets. On the other hand, transition risk could affect developed markets more, as these countries are more likely to spend more on climate-related mitigation and adaptation in the long term. Next slide, please. Thank you. Moving on to equity. Equity measures typically include country and sector analysis as part of their investment process, and climate-related considerations would be part of this process. Carbon emissions and climate-related impacts vary significantly by sector. For example, finance and transport industries clearly have very different emission profiles. Even within the same sector, there could be great variability in the emissions. For example, when we compare fossil fuel and renewable energy generation, both of which are from the energy sector. In terms of transition risk, the most adversely impacted sectors are typically carbon intensive. From this chart on the right, there would be the energy, transport, materials and buildings, as well as agricultural sector. These sectors will have to make extensive efforts to reduce greenhouse gas emissions. However, this impact could be offset by technological opportunities if the companies pivot to lower carbon production methods or products. On the other hand, physical risk impact on equity is more spread out over various sectors. The main driver of physical risk would be the location of the firm's physical assets rather than sector. Nonetheless, energy and agricultural sectors would be even more affected, given that the extreme weather could affect their infrastructure. Next slide, please. Thank you. Yeah. So moving on to real estate and infrastructure. Financial institutions usually invest in real estate with the intent of holding for the longer horizon, making it more susceptible to long-term physical and transition risk. Physical impacts on climate change on real estate naturally depend on the location. For example, real estate located in the coastal area could be more affected by floods, lower occupancy rates due to immigration, and higher insurance premiums. Also, transition risk could affect the building and operating costs of real estate, as building and operations contribute to 1/3 of the global final energy consumption. On the other hand, in terms of infrastructure, climate change policy is likely to reduce the value of some assets which are less likely able to adapt. Some assets such as coal-powered utilities could become stranded as they succumb to obsolescence due to new regulations, greener alternatives, or technological innovations. On the other hand, asset owners are increasingly willing to provide project financing for the development or construction of real green assets, such as solar power generation or wind farms. There could be increased demand for new infrastructure, which is more resilient or more adaptable to physical risk. Next slide, please. On derivatives on agricultural assets, derivatives could be used to immunize a portfolio if the underlying risks are exposed to the downside impacts of climate risk. Also, agricultural assets are drawing more attention in climate discussions these days, primarily due to the direct emissions of methane from beef and dairy farming, as well as the land use changes with deforestation. However, investment in regenerative agricultural practices and forestry carbon capture could reduce the total emissions of a portfolio. Next slide, please. Given that green assets are increasingly prominent for investors, I'd like to talk about what it means and their investment characteristics. The most commonly available green assets are green bonds, green infrastructure, and green real estate. The main challenge is to assess whether an investment qualifies as green or not. A risk here is greenwashing, meaning that the issuer could market the investment in a way that it appears more eco-friendly than it really is. To combat greenwashing, the EU created a taxonomy for sustainable activities. For an economic activity to be considered sustainable, it will have to make a substantive contribution to one of the 6 environmental objectives shown on the right, do no harm to the other 5, and meet minimum safeguards. So aside from the EU, the UK is also developing its own taxonomy, which is likely to be closely aligned with the EU version. China and EU also announced a common ground taxonomy last year, showing some consistency in their respective approaches. Next slide, please. So to summarize, the main differences between non-green assets and green assets are that green assets are normally linked to an underlying eco-friendly activity. For example, renewable energy investments or schemes to reduce energy usage in heating or transport. Green bonds often have a premium, also called green premium, which means lower yield for those raising capital. This premium increases with demand as investors may be willing to accept lower yields on such investments. As of today, the presence and extent of premiums is still under debate and more studies are being done. So it's not so conclusive yet. Thirdly, green assets represent a small, a bit rapidly growing market, potentially subject to low liquidity. So it might be more suitable for investors with a longer horizon. And these assets have been funded to a greater extent via private markets rather than publicly available markets. Hence, their disclosure requirements may not be as extensive or stringent, something we just have to take note of. Yeah. Next slide, please. Thank you. After discussing the consideration for asset classes, we can now look at how companies may measure climate-related risk. Here, we summarize 4 main types of metrics, but actually there are a wide variations in practice. If you are interested, the TCFD 2021 status report is a great source of information. So firstly, overall portfolio alignment refers to the proportion of the portfolio committed to net zero by 2050. The TCFD also recommends to look at the percentage of the portfolio invested in carbon-related sectors. The benefit of this method is that it is relatively simple and transparent. However, there is no forward-looking analysis of each company's strategy to achieve the target or how it might be impacted by various climate scenarios. Secondly, portfolio emissions. Investee companies could disclose their emissions and set targets for their emissions. Then at the portfolio level, the asset managers could compile this for the entire portfolio. Such metrics would depend on the availability of emissions data from the companies, which has certainly improved in recent years. The beautiful side of it is that it's a relatively simple method. However, a potential concern is that the purchase of carbon offsets could reduce headline emissions figures, which leads to a lack of comparability in reported numbers. Thirdly, implied temperature rise. The implied temperature rise of an asset broadly tries to estimate the global temperature rise as if every company in the world operates on the same carbon intensity as this asset and experiences the same emissions pathway as this asset. As it sounds, the challenge is that this metric is relatively new and still evolving. There are major technical and methodological challenges to calculate. And there's no commonly agreed terminology yet. So it's quite challenging to compute this kind of implied temperature rise. Last but not least, climate value at risk. Climate VaR quantifies the size of loss attributable to climate change, climate-related financial risk by comparing the value of assets in a world with climate change relative to the same world without climate change. As it sounds, it's a very model and data intensive measure, and it lacks transparency and comparability. The scenarios used by each company could be widely different, so it could make it difficult for investors to understand what these figures mean. Overall, these metrics are still evolving, and we should be mindful of their limitations, especially in terms of data availability, comparability, transparency, and intensity of computation. Yep. Moving on to the next slide, please. So next, I'll share our observations of some common features of insurers implementing climate-related risk analysis. As actuaries, you know very well, life insurance companies generally have large portfolios with mainly low-risk assets matched to the liabilities. So climate-related risk could impact life insurance companies mainly in terms of credit and market risk with limited impact on the liability side. So life companies could review their investment portfolio for exposure to climate-related risk. They might also investigate the impact of short-term and long-term climate events and changing climate conditions on their investments. After performing the internal analysis, these companies could then identify ways to disclose their findings. Regulators may ask for specific formats, and companies often use their annual report for disclosures as well. Moving on to general insurance companies. While general insurers often have a long-term business strategies, many of them predominantly underwrite short duration and yearly renewable contracts. Hence, their investment portfolios are more heavily weighted towards cash and other highly liquid assets. So physical risks affect the liability side more than the asset side. On the other hand, extreme weather events might restrict access or power to the insurance facilities and impact their short-term operations. Yeah, next slide, please. Yeah. So last but not least, we also look at a case study related to pension funds. We took reference from an excellent paper from IFOA published in 2020 about climate scenario analysis for pension schemes. So this paper mainly looked at 3 climate scenarios and simulated the impact on GDP and other financial and economic variables on a stochastic basis. The first scenario is an orderly transition to meet the goals of Paris Agreement. The second scenario is a disorderly transition, but still meet the goals of Paris Agreement ultimately, and the third scenario being a failed transition. Based on the results, the Paris orderly transition pathway shows the most favorable funding level projection in the medium to long term. This pathway is also far more preferable for the economy as it's less disruptive. Interestingly, in this case study, the disorderly transition scenario actually produced the worst result. It's mainly driven by an abrupt and unanticipated financial market reaction. Under the failed transition scenario, the paper assumed that the pension fund would reduce risk earlier, resulting in a smaller drop in funding ratio compared to the baseline. However, the timing of climate effects is very uncertain, and if the impacts of failed transition started to emerge before the pension fund reduced risk, the failed transition scenario could well be the worst scenario of the 3. So the IFOA paper also mentioned that not all risks are fully captured in this model. For example, it does not fully capture the environmental tipping points and knock-on effects such as climate-related migration. If you're interested, the IFOA paper is publicly available online and is a great reference as well. Yeah, next slide, please. So as Andre mentioned at the start of our presentation, the assessment of assets is an integral part of actuarial work. We need to understand the potential impact of various climate scenarios on assets and the current frameworks to measure and report the risk. To summarize quickly, we talk about the scenarios we can use, where we could find all these scenarios. And depending on the purpose of our climate-related risk assessment, actuaries could start with a bottom-up or top-down approach. And thirdly, there are additional considerations by asset classes, and various risk measures could help us to capture the impacts of climate-related risk well. So as you leave this webinar today, we hope you have a better understanding of this topic. With that, I'll pass the time back to Andre. Thank you. Yeah, back to you, Andre. Andre, I think you might be on mute.
Yes, thank you, Eileen. Thank you very much. So that ends the summary of our paper. I was allowed to address to you some thoughts and ideas that I've been talking about in as part of my work as chair of the Climate Change and Sustainability Committee of the Canadian Institute of Actuaries regarding opportunities for actuaries going forward in the climate space. So what I want to talk about, well, first, these are my own thoughts and ideas, and you can basically ask me questions later on, but I see two levels of involvement for actuaries going forward, or for the actual profession, global actual profession even. So one level is what we're familiar with, technical level, so where actuaries are applying their skills in modeling, scenario analysis, stress testing, etc., our bread and butter, what we've been used to do for other financial risks. We can apply that on the climate risks. But the other aspect is engagement, and it became more and more evident to me as time went on as part of my role that our profession needs to collaborate with other professionals, regulators, scientists, and politicians. And we're doing that now with the IPCC collaboration. But the goal is to build the right sustainable financial sector for the planet. Because what's the use of a pension if you can't breathe the air you live in, or you have to stay stuck in your home because of some pandemic or whatever? So this engagement goal is also aligned with the mission of my professional body in Canada, which is to advance actuarial science for the financial well-being of society. And also our rules of professional conduct state that members must comply and thereby serve the public interest. It's possible your own association have similar rules as well. I know climate risk is daunting for many actuaries. It's new. Traditional methods may not always be applicable straight away with climate change. New mindsets, new processes are needed. So it's not just new technologies that are needed in the future, also new processes as well. But I sincerely think that when society sees a reputable profession like ours filled with, let's say, very smart people, when they see us getting more engaged in climate change, then I think it will compel other areas of society and professions to be a part of the solution as well. So on the technical involvement side of things, you see a couple of things here that you probably thought about already. But one I want to focus on is creating innovative products that align with the changing needs of stakeholders. For example, in the general insurance sector, climate impacts on agriculture include higher temperature, stronger storms, and changes in rainfall patterns, all of which can reduce yields, especially in sub-Saharan countries, for example. With conventional insurance, indemnity-based insurance, payouts are based on what happens to an individual farmer's crop. It does not create an incentive for farmers to work hard to save a crop in that year. But there's new types of insurance that are more index-based and provides payouts that are triggered by not observed damages, but rather an index based on wind speed or amount of rain during a certain window of time. And so that could be something that could lead to new innovations on the insurance side of things. Same thing with property insurance in the hurricane zone, hurricane-prone zone. Definitely, there will be more focus on the building codes and standards used in construction as to whether the structure can subside against extreme weather patterns. And on the engagement side of things, so the IAA is in the process of drafting a paper, paper number 6 on adaptation, based on the IPCC Work Group 2 that came up with a report in March or February entitled Climate Change 2022 Impacts, Adaptation and Vulnerability. So adaptation is really something we need to focus on. I mean, it's good that we're focusing on mitigation, but adaptation is real and it's now. It's happening now. I was on a call last week with a group of entrepreneurs and innovators in various countries talking about climate change, and one person from a small island in Africa was telling me how their island is already getting increasing in rising water levels and the coastlines being affected. So it's real. It's happening now, and so that's why there's going to be a paper from the IA on that topic. So basically, I'm going to stop here at this point. I want to thank you for your attention, your interest in this latest paper. I hope you read it and that it is valuable to you in your work as actuaries, and hoping you're getting more engaged as well in the topic. So I'll go on. I'll leave it on to Gabor now to moderate. Oh no, I think we have another call, another talk actually.
Okay, thank you, Andre, and thank you, Eileen. So we turn our attention to our next speaker, William Harding of the Sustainable Insurance Forum, and he will be talking about what the SIF and its members are doing and how they see the actual contribution. So William serves as the head of implementation for the United Nations Development Programme's Sustainable Insurance Forum. Prior to his appointment to the SIF Secretariat in 2021, William worked in the climate risk team of the Australian Prudential Regulatory Authority, APRA. William joined APRA in 2017 as a member of the superannuation policy team before moving to the insurance policy team, where he contributed to a wide range of prudential and regulatory issues, including implementing the recommendations of the Australian Royal Commission into misconduct in the banking, superannuation, and financial services industry. In 2019, William was seconded to the Bank of International Settlements as a Financial Stability Institute Fellow. So, William, please, the floor is yours. Deliver your presentation.
Thank you so much, Gabor, for that kind intro, and thank you all for having me today. I'm very pleased to be joining the webinar and to continue our support for the great work that the IAA has been doing and continues to do in supporting actuaries to build their skills on climate risks in particular. As Gabor said, I'm Will Harding. I'm the head of implementation at the Sustainable Insurance Forum, or the SIF. And on the next slide, we just have a little bit about what is the SIF. So we are a global leadership group of insurance supervisors and regulators working together to strengthen our understanding and response to sustainability issues. We've recently, very recently, in fact, grown to 36 members with great coverage across the globe in terms of market share of insurance companies regulated. If we just move on to the next slide, we have a quick overview of the SIF. It was launched in December 2016 and is convened by the UN with the SIF Secretariat, where I work, hosted by the UN Development Programme in the Sustainable Finance Hub. We have a core partner in the global standard setting body, which is the International Association of Insurance Supervisors, the IAIS, And we're also an observer of the Network for Greening the Financial System, the NGFS, which, as we'll see, is a key organization that's helped to produce a lot of the scenarios that are the basis for a lot of the climate risk scenario analysis. But as we'll see, we're also, through the SIF, key partners with a number of other institutions. And ultimately, our goal is to be a dynamic platform for insurance supervisors, and we continue to be member-led and strive to support our members in what they're doing. And you can see on this slide just an overview of some of our partners, because we tend to operate with a small secretariat ourselves, but working in partnership with other world-leading organizations to share their expertise with our SIF members, being the insurance regulators, and also to promote our partner organizations to a wider audience. So this slide just gives a small taste of it, but we'll delve into some of these partnerships in a little bit more detail. So if we could move on to the next slide, please. Let me just highlight very quickly some of the relevant recent work of the SIF. So if we go back to 2018, that was the first kind of strategic partnership between the SIF and the IAIS. And this led to releasing the issues paper on climate change risks to the insurance sector. And in 2018, this was the first piece of guidance of this type from an international standard setting body. And then in 2020, we continued our partnership with the IAIS, and we produced this second issues paper. And this one was really focused around the TCFD and supporting insurance regulators to be able to implement the recommendations of the TCFD, which of course, as we know, includes scenario analysis. We found in 2020 that there was a fair bit of work to do in terms of implementing this, but thankfully it's developed since 2019 and 2020 when that paper was developed. Another highlight of the SIF work is the SIF question bank, which provides a kind of practical tool that supervisors are using to develop their own approaches to managing risks. I like this one because it gives an insight into the kind of questions that supervisors may ask of insurance firms. And it is available on the Sustainable Insurance Forum website if anybody wants to get some insight into the kind of questions that insurance supervisors may ask of their supervised companies. And then lastly, I think a really key one is this application paper on the supervision of climate-related risks in the insurance sector. So this was our most recent partnership with the IAIS again. And this one maps climate risks to the existing insurance core principles, which are the global insurance standards set by the IAIS. So this paper, it provides really good insight into the current trends in supervision, and it showcases various ongoing initiatives by the SIF and the IAIS members, because it incorporates a number of case studies that are ongoing from a regulator's perspective. So if we move on to the next slide, we have just a little bit of background about some of the key pieces of work from the SIF over the last year, and then we'll delve into what's planned for the next year. And then I'd like to finish on some scenario analysis and portfolio management issues in particular. So the first highlight here is around capacity building, which is a key focus of the SIF. In November last year, we launched the Climate Training Alliance, which is a collaboration between the Bank for International Settlements, the NGFS, the IAIS, and the SIF. And here we're aiming to enhance the availability of training resources for insurance and banking supervisory authorities. So we're bringing together those at the cutting edge of climate risk management, so they can share their experience with the rest of the central banking and supervisory community. And what we have here is a kind of a platform that allows access to all members of one of these insurance supervisors to be able to access a whole range of training on a number of different topics. A couple of examples here are the Financial Stability Institute training and the Access to Insurance Initiative online training modules, which are really built around the climate risk training that we discussed in those issues papers. And then I mentioned a little bit our ongoing partnership with the IAIS, so I won't dwell on this slide for too long, but I think it does highlight one of our strategic aims for this work, for the SIF's work, which is to be aware of the work of a number of other international forums, because we understand that importantly, climate risk is a feature of a number of international forums, not least of which the IAA. And we want to be able to deliver helpful work and to not unduly increase workloads or to double up on activities. We've been very pleased to be represented on the steering committee that the IAS recently established. So just at the end of last year, they established their climate risk steering group and identified 3 key streams of work. And one of those is the scenario analysis, which we'll dive into in a little bit more depth. And of course, we have some of the success of the recent application paper and webinars there. So if we move on to the next slide, please. Here we can see the SIF's scoping study on nature-related risks in the global insurance sector. So this study really marked a pioneering effort to explore and understand the insurance sector's dependence on nature, what nature-related risks could be, whether and how nature-related risks are financially material to the sector's business, both on the underwriting and investment side. And really with the SIF members and partners, as well as experts and industry participants, we had some really great contribution to this study. We had a mixed research methodology and a survey of 108 insurance sector participants across 32 countries, including insurers, reinsurers, industry associations, and also brokers. And what we were doing, we were trying to gauge the financial risks of nature-related loss or biodiversity loss and assess how insurance supervisors and companies are responding to these risks. The paper itself, it finishes with a number of recommendations, both to insurance supervisors and also to the industry. So I encourage everybody to read up on that paper if you're interested in the topic of nature risks and biodiversity as a topic. On the next slides, I spoke a little bit about our SIF's work in terms of supporting the recommendations of the TCFD to be implemented among our members. And while we had quite an in-depth issues paper in 2019 and 2020, we thought it was worthwhile to update for COP26 and to get some insights into what the kind of current practices were. This is, as well as outlining the supervisory and regulatory practices in terms of how implementing the recommendations are going, it also, I think, highlights that the TCFD recommendations are really becoming the preeminent disclosure framework for climate-related risks. It's going to sit alongside the developments of the ISSB that we spoke about. But I think it does highlight that disclosure continues to be a very relevant topic at the moment. It's really a focus of industry and regulators alike. And when we're talking about disclosure, you have to actually have some work to have done the work to be able to disclose the insights from that. So I guess that's again where scenario analysis becomes so important. And then the final piece of work for 2021 that I'd like to highlight on the next slide, please, is our work with the IAA. So this speaks a little bit to some of the engagement that Andre discussed, because SIF members have themselves recognized the importance of the actuarial function, the massive influence that the profession can have on the entire operation of an insurer. But we, as the SIF and the insurance regulators, have recognized that we're not necessarily the experts on the actuarial function. I mean, a number of our members have certainly a lot of technical expertise, but I'm definitely no actuary, and I'd be scared of the exams, I think. So we sought to partner with the experts, which is the IAA. And through this, we're able to help to support the actuaries to increase their own knowledge and capacity on sustainability issues and climate risks. And through that, SIF members have agreed that this is really a fantastic opportunity to influence the industry as a whole because of the importance of that work. I think we've been quite successful to be able to do this so far. We've been lucky enough to contribute a supervisory perspective to the IAA series of papers as they've been developed. And today is obviously one such clear example where we as the SIF, the image here is me with a bit of a COVID lockdown lack of haircut, but we were able to host a joint webinar at the end of last year, being able to promote the paper on climate-related scenarios applied to insurers, and we were very happy to be able to have the chance to do that. And so if we move on to the next slide, we'll just quite quickly take a look at the SIF 2022 work program. Really, it all begins with member and partner engagement. And especially while we're in a virtual world still, we're trying to maintain a member-led organization and be supporting our members, both through virtual and in-person meetings. But through our engagement with members, we've got some key topics to kind of focus on for this year. The first one here is continuing on the nature-related loss theme. So with the successful publication of our scoping study at the end of last year, what we'd like to do now is we've begun to disseminate the insights from the paper, both at events, but also importantly, to develop a self-directed learning tutorial on understanding and assessing nature-related risks that will post onto the Climate Training Alliance, and then supervisors will be able to have access at their own discretion to that training. An interesting one, I think, is around the of course, we have the climate risks in actuarial processes, because this is maintained on our radar, and we certainly haven't just forgotten about it based on the success of last year. We're very keen to build on this success. We're very keen to continue to be able to support the development of the IAA series of papers, where we can give our input from SIF members who have that supervisory perspective. Also to be able to disseminate the insights to as wide an audience as possible, because really getting as many eyes as possible on this material, I think, is key, and not just for actuaries, because there's a lot of thinking and technical expertise contained within these papers, and so we're keen to support their publication and also the dissemination of that info. And then we've spoken quite a bit around capacity building, where the SIF is continuing to support the Climate Training Alliance, but we're also hosting often regulator only kind of based workshops, where we're having discussions around these key topics like nature risk, like the net zero and the Net Zero Insurance Alliance, of course, around scenario analysis and disclosure, where we want to be able to have active workshops where SIF members can bring their live discussions and learn from those of their peers who have maybe been through this already. And then one that often piques a little bit of interest is the climate capital piece. So what we're trying to do here is just undertake some work to help support SIF members to kind of understand what could or are current regulatory capital settings taking account of climate-related financial risks, and support some deeper research into how these calculations might be done. Of course, we're not trying to predict the future or make bold statements around what changes to capital settings might be. That would be for each jurisdiction to set for themselves. But what we are trying to do is to help with some of this deeper research around what might these calculations look like, what might the changes to the settings need to be, or to the frameworks need to be. So if we move on to the next slide, please, we see an outline of the SIF and the IAS project on scenario analysis that's underway this year. So this chart may be a little bit difficult to see, but I think you can get the idea of what we're trying to do. Essentially, we're committed to supporting our members in undertaking their own scenario analysis exercises, and we're really focused on practical implementable tools that will support these questions. So we've got a little bit of a process now that we're currently underway, where we're using a number of different sources of knowledge to kind of get the expertise from this range of people. So we have, of course, we as with so many of these things, begun with a stock take survey, where we've got some insights into what are the regulatory insurance scenario analysis exercises that have already been conducted, are planned, or are already underway. Through that, of course, we've got a lot of insight into the kind of challenges that the supervisors might have had in setting their exercise, and also the kind of challenges that indeed companies may have faced in trying to implement the supervisor's wishes. And then we're currently in the process of undertaking these knowledge in exercises, where we're utilizing a number of workshops and getting the experts in. So these experts may be around there may be supervisors who have already completed an exercise, or they may also be external experts. So for areas around modeling insights, you might have the modeler speak. For more scientific areas, you may have academics or the scientific experts coming to speak. And then we will group material under these 9 elements that are here. So we're really ranging the entire, running the gamut of the scenario analysis process here to get some insights into each of these 9 elements that are outlined. And then we will undertake a process to disseminate that knowledge with a number of workshops in what we're calling the knowledge out sessions. And like I said, this is all going to culminate in this material for dissemination, which we're focused on producing by the end of this year, some really practical resources that can support our members. At the end of this process, we will also look to what further work we may have to do for the end of next year. We of course have a tight time frame for these current resources to be delivered by the end of this year, but that reflects the fact that it's clearly a focus, I think, of so many companies and regulators alike, where if there's not already an analysis underway or completed, there's certainly a number of regulators who are planning their work. And so we're trying to solve or to help feed into some of these live issues that some of our members are facing when they are undertaking their own analysis. But as I said, next year we may look to some of the slightly longer burn work, such as issues papers or applications papers, which will allow for wider consultation. And if we move on to the next slide, please. So we've taken a look at the ongoing scenario analysis work between the IAS and the SIF. I think it's a smart idea to review the application paper that I discussed previously. So this application paper was published just in the middle of last year, but it continues to inform our work and those of our supervisory members. So here we're taking the ICPs, which are the insurance core principles, the global insurance standards, and we're also taking practical examples of what the insurance regulators are doing on a wide range of issues relating to climate risks. But for asset portfolios, the topic of today, we have ICP 15 on investments and ICP 16 on risk management, which includes standards for supervisors that require insurers to construct their investment portfolio so that it's adequately diversified, and so that payments can be made as they're due, to invest in a manner that's appropriate to the nature and duration of liabilities, to invest in assets where it can properly assess and manage the risks, to include in ERM frameworks an explicit investment policy, and include an ALM policy in the ERM framework. So when supervisors consider the risk in insurers' investment portfolios, I think it's important to assess whether the insurers incorporate the potential impacts of climate risk into their investment decisions. As we saw, both transition and physical risk have the potential to affect investments via credit counterparty default risk, such as an increase in the probability of default or loss given default. It can arise in market risk through a change in the value trend or the volatility of an asset or derivative, in particular equities, property or spread risk. And also as liquidity risk, for example, through a result of a sudden cash outflows as a result of a natural hazard. So climate change can definitely negatively affect the asset portfolio, and it can also negatively impact the matching of assets and liabilities, primarily through transition risk, as insurers with long duration products use longer term bonds to match the liability cash flows. And then due to the long-term nature of the bonds, insurers should consider the potential that individual firms or even an entire sector could be significantly impaired over the matching period when constructing their investment portfolios. Of course, the time horizon is really an essential component, as the impact of climate change on investment portfolios is likely to materialize over an extended period and therefore impact either the value or expected cash flows from financial assets only in the longer term. So a forward-looking view, including the use of scenarios, may help insurers to gain the better understanding of the risks. And indeed, certain institutional investors, which obviously includes insurers, are applying engagement strategies to steer the activities of the assets they're holding. And we think that this kind of stewardship could really act to influence the strategy and business of the firms in which they are investing to progress towards sustainable economic activities and contribute to reducing climate-related risks. So I think a point that we often like to hit home is that insurers as institutional investors actually have really a lot of power when it comes to the weight of money. And if we could move to the next slide, please. So here, I'd like to finish on a slide that I've borrowed from my colleagues at the Bank of England in a presentation that the CCBS delivered at the end of last year. And this represents some of the key decisions that supervisors are making in structuring their scenario analysis. You can see this slide. So of course, this is will actually be updated because there's a number of ongoing analyses from a regulatory perspective, even from just last year. But it does give some insight, I think, into some of the decisions that need to be made as they're designing their assessments, and our work across this year is really around helping to assess the pros and cons of each of these key decisions. So I think you can see here that time horizon can be a key decision to already make. How you treat the balance sheet, whether you actually allow for management decisions in the balance sheet on the investment side is really key to the kind of results that you might receive. And ultimately, I think what it comes down to is the objectives that need to be set at the very beginning of doing this assessment. If you're looking at more physical risk, of course, you want to look longer term where those kind of risks actually eventuate. But if you want to focus on transition risks and economic values and potentially investments, you may want to have potentially a shorter term and allow for a dynamic balance sheet. And you'd obviously be looking at different types of risks there. I think ultimately what it comes down to, and if I can give a piece of advice that I'm certainly is not new, but it is worth echoing, I think, is that while there's a lot of pros and cons for each and potentially difficulty here, I think there's consistently we see that there's a lot of benefit to just starting. A lot of insurers may find it daunting, or insurance regulators may find it daunting when you look at the range of things that need to be assessed, and it's slightly different to perhaps other scenario analysis work or stress testing work. But really, even if you begin just at a qualitative assessment, you may learn some lessons, and you may find that actually now you know where to focus the quantitative work in the next step. And of course, the CIF and the IEAS, we're continuing to work to support our members with the guidance and resources that they need. The NGFS has published their scenarios, and they have some guidance around this. And everybody will say there's no right or wrong time horizon or balance sheet decision, depending on the nature of the jurisdiction and the potential physical and transition risk exposures, and of course the maturity of the industry. I think really it's just important not to let perfect be the enemy of good, as both supervisors and industry are rapidly developing our skills. And at the CIF, we're certainly seeking to fast track the process for our members wishing to undertake such analyses, because as a global body, we can facilitate the sharing of the knowledge and experience of those who have been through the process. So we have an open and engaged international regulatory community who are really keen to share the lessons we've learned with our peers, and we're always willing to help. So my final slide here is just a chance to say thank you again for this opportunity to speak, and also really a massive thank you to the IAA for our ongoing partnership, and to the drafting team of paper 4 here today for really the helpful resources that you're continuing to produce. So thank you very much.
Thank you, William. It was a very interesting presentation, and I think I can just confirm that within the IAA, we are very happy with the cooperation between our organization and yours, and trust that we will continue with a good relationship. So now we have the last part of the webinar question and answers, and I've noticed some questions and some contributions in the chat and Q&A. So perhaps I can summarize some of them. One of them was coming from the past president of the IFOA, saying she was happy to hear about the adaptation issue being important, and I can say that our task force, the climate risk task force of the IAA, started work on 2 future papers already. One of them is close to be released for consultation as an exposure draft. That is going to be on climate-related disclosure and risk management. However, the other one, which is in an earlier stage at the moment, will be on adaptation issues. And so that is expected to be in the exposure draft phase toward the end of the week, optimally before the COP27 meeting. So that's our working goal. Now, when it comes to the presentation from William, and he mentioned the capacity building programs at the CIF and IAIS, I got a note that the IAA has contributed capacity building in terms of actuarial knowledge to some regions in the world. It has been, or they have been, quite successful programs aiming at general actuarial knowledge for supervisors, but I think this can be considered to be extended to climate-related actuarial contribution as well. Now, when it comes to questions, one of the questions aimed at saying how, I mean, I'm paraphrasing and condensing, but how can extreme weather indices help management of asset portfolios in relation to climate risk? So either Andre or Eileen, can you comment, or maybe William, can you comment on this? So you are aware that there are some climate or extreme weather indices around the world, and how can they contribute to the management of asset portfolios, how effectively they can be used. Anyone would like to respond on that?
There's certainly a couple.
Guess,
Oh, sorry, Ali, go ahead.
sorry, maybe I'll go for a quick comment. I guess the extreme weather indices, I haven't known of any practical example, but I guess it could be part of the derivatives to hedge the, let's say if the underlying assets have some impacts, exposure to the downside climate risk, then this extreme weather indices could be used as part of the derivatives. Yeah. William, you wanted to add something on?
I think I would just echo that, really, that I think part of the scenario analysis piece is to build up a picture to as much granularity as you can, I suppose, around what the physical and transition risk impacts will be. So if, I guess you're taking probably every single source that you can find, from scientific research to kind of more developed scenarios where you can maybe a little bit closer to plug and play. But if you can get that granularity around geographical physical risk insights, then the institution conducting the analysis, I guess, can only be further informed by mapping those kind of physical risk insights, including the indices to the kind of sectors or geographical locations, and that kind of in-depth or continued drilling down into further granularity can only be helpful, I think.
Thank you. Perhaps another question, and I'm again paraphrasing it. So would the uncertainty related to asset values due to climate risks lead to downgrading the ALM activities, so the asset liability management or matching activities of certain service providers, and that in turn could that lead to offering less of certain types of services of insurers and pension funds? because of this uncertainty and because of the less meaningful ALM activities? Anybody of the presenters could respond on that?
I can try to answer that one.
Go ahead, Andre.
Yeah, well, I mean, this is happening on the P&C, on the general insurance side, whereby some insurance companies may start, getting out of certain markets or certain perils linked to climate change. So, but I wouldn't go as far as saying that there's a lack of value in ALM. I mean, I think the scenario analysis and planning still has value, and that's not a one-time exercise. That's something that I think will agree that this is like an ongoing process. You need to start at one point, but you need to go on and continue refining your analysis as new information comes in. And remember that climate change will affect markets and populations, but if insurance companies are taking the view that they need to get out of certain products or markets, well, somebody will have to step in. I mean, probably, then the government will need to provide some kind of relief to the population. So what I mean is that the problem that doesn't disappear, it just gets shifted to another level, which is the government level. And I think the solution is more of a kind of like private-public partnership for the future, whereby the insurance companies continue to cover certain aspects and the government maybe other aspects, but still there needs to be some partnership.
Thank you. And finally, I would like to quote one question to which I would like to answer. The AI is doing some great work. How can it influence the North American insurers in particular to cut their fossil fuel exposure? Well, the IAA is not a lobby organization. So our influence is entirely through our professional contributions, papers, and discussions. What's more, the I is global organization, and we have there is a basic principle of how the I is operating. It's called the principle of subsidiarity. So the I will never interfere with a region's policies unless the respective actuarial organization in that region requests the IA to do so. I don't think it will happen in terms of North America. So I think time is up now. So maybe there have been some other questions or contributions which I have not quoted, but I hope that you enjoyed and learned from this webinar. As I mentioned, the presentations and the recording will be posted to the IA website after some time. And my advice to you is that from time to time or regularly check the IA website, the climate part of the IA website, and also the website of the SIF in order to find more recent and up-to-date information. But you will receive messages when this climate risk task force releases the exposure draft for the next paper and when new developments occur within the IA through your member associations. So I'm asking our presenters, speakers, if they have any final comment or contribution to say. If not, then I thank everybody. I thank the presenters. Thank you, Andre, Eileen, and William. And I thank the Secretariat of the IA who helped this webinar to come through. So with that, saying that, I wish you a nice further day, good morning, good evening, and good afternoon to everybody. Thank you. Bye.